SMX, Security Matters PLC, is currently trading at $34.52 as of the market close on March 5, 2026 at 2:29 a.m. IST. This represents a complex consolidation period for the stock, which has seen a range between a day high of $35.99 and a low of $32.34 during the most recent session. While the broader market often views a price tag in the $30 range as a sign of mid-tier stability, the reality beneath the surface for SMX is far more volatile. This is a company that has experienced a staggering 99.89% drawdown from its 52-week high of over $31,000, a figure inflated by a series of aggressive reverse stock splits designed to maintain NASDAQ compliance. The immediate expectation for many retail traders using the Robinhood app or looking for a quick win in a low-float environment is that a bottom has been found, especially with the recent $250 million capital commitment extending their runway into 2028. However, the reality is that the market is currently grappling with the tension between a theoretically massive total addressable market and a balance sheet that has historically struggled with a massive accumulated deficit. The curiosity loop here isn't just about whether the stock can reclaim its former glory, but whether its molecular marking technology can actually transition from pilot programs to standardized global infrastructure. Most investors look at SMX and see a struggling penny stock that keeps shrinking its share count to stay alive. The deeper, more contrarian take is that the company has spent the last year quietly shifting from a technology provider to an infrastructure play. By securing a $111.5 million equity purchase agreement and following it up with an expanded credit line, they have effectively removed the immediate threat of bankruptcy that has haunted the ticker for years. This doesn't mean the risk is gone. It just means the nature of the risk has changed from existential to execution-based. When you are looking for investment help or evaluating online investing options, the distinction between a company fighting for air and a company funded for growth is everything. Recent stock movement has been a whirlwind of high-volume spikes followed by grinding sell-offs. In early February 2026, the stock saw a massive 89% surge in a single day, only to give much of it back as the mechanical reality of its 4.88-to-1 reverse split took effect on February 17th. This volatility is a hallmark of low-float stocks where institutional activity is sparse and the price is dictated by retail sentiment and algorithmic trading. For those using the SoFi trading platform or managing an individual brokerage account, these swings offer high-stakes opportunities but require a disciplined approach to risk. Institutional interest has remained cautious, likely waiting for a clear signal of revenue generation rather than just capital raises. The trading volume has remained elevated compared to historical averages, suggesting that while the price is suppressed, the market's eyes are firmly fixed on every SEC filing and press release that hits the wire. Common ground in the investment community suggests that SMX is a show-me story. The narrative is that the technology, marking everything from gold to plastics with a submolecular barcode, is brilliant, but perhaps too early for its time. I challenge that by looking at the regulatory environment. We are seeing a global shift toward mandatory supply chain transparency. From the European Union's requirements for recycled content in plastics to the push for conflict-free gold in the Middle East, the world is moving away from administrative trust and towards scientific proof. SMX isn't just selling a marker, they are selling an audit trail that cannot be forged. This is the reality that could eventually overwhelm the current expectation of continued failure. If you are doing your own self-investing or using online investment sites to find under-the-radar plays, the focus should be on the adoption curve of their plastic cycle token and their partnerships in the precious metals sector. What does the company actually do? At its core, SMX integrates chemistry, physics, and computer science to give physical materials a digital memory. They embed tiny particles into raw materials, liquid, solid, or gas, which can then be read by a proprietary scanner at any point in the supply chain. This creates a digital twin on the blockchain, ensuring that if a company claims its shoes are made of 50% recycled plastic, there is an invisible, unbreakable record to prove it. This business model is aimed at brand owners and manufacturers who are under intense pressure to meet ESG commitments. While older reports showed a lack of meaningful revenue and a heavy reliance on dilutive financing, the late 2025 and 2026 strategic shifts have been about cleaning up the cap table. They have focused on reducing long-term liabilities and establishing a treasury that might even include digital reserve assets to align with their blockchain-based tracking systems. Looking at the future outlook, we have to talk about the catalysts. The primary driver for SMX in the coming months will be the conversion of their current pilot programs into long-term revenue-bearing contracts. They have recently announced collaborations with players like M2I Global for critical minerals and initiatives in the luxury fashion world to track cotton and denim. These aren't just PR stunts, they are stress tests for a global rollout. The risk, of course, is that the capital facility they've secured acts as a ceiling on the stock price. Equity lines of credit often involve the sale of shares at a discount to the market price, which can create a persistent overhang. Investors using the Fidelity mobile app or Interactive Brokers trading platform need to watch the drawdown announcements closely. If the company draws on the facility while the stock is weak, it could lead to further dilution that offsets any technological progress. The tension between expectation and reality is most visible in the verification economy narrative. The expectation is that companies will continue to use paper-based certifications because they are cheaper and easier. The reality is that the cost of fraud, especially in the gold and rare earth markets, is becoming so high that an invisible molecular marker becomes a cost-saving measure, not an expense. This shift in the cost-benefit analysis is what the market is currently ignoring. If SMX can prove that its technology reduces the insurance premiums or regulatory fines for a major mining company or a global recycler, the valuation will no longer be tied to penny stock metrics but to infrastructure multiples. Comment below with your take on the verification economy. Do you think the government will pass legislation in favor of mandatory molecular tracking for recycled goods anytime soon? For those looking at the broader landscape of investment sites, SMX represents a specific type of high-risk, high-reward play that is often found in the corners of an intelligent portfolio. It's not a set-it-and-forget-it investment like the Fidelity ETFs or Vanguard mutual funds that form the bedrock of many retirement accounts. It's a speculative position that requires constant monitoring of volume and institutional flow. The fact that the company has implemented a shareholder rights plan to counter hostile takeovers tells you that the board believes there is deep value in their patent portfolio that isn't reflected in the $34 share price. They are essentially building a moat around a technology that hasn't even hit its full stride yet. As we move through 2026, the macroeconomic pressures of inflation and supply chain fragility could actually serve as tailwinds for SMX. When resources are scarce and expensive, knowing exactly where they came from and what they consist of becomes a competitive advantage. This is the central insight. SMX is trying to become the Intel Inside for the circular economy. Whether you're using Schwab Intelligent Portfolios or a more hands-on approach with the Interactive Brokers platform, the question remains whether you believe in the transition from promises to proof. The expectation is that the stock will continue its pattern of splits and slides. The reality may be that the groundwork for a standardized tracking infrastructure has finally been laid, backed by a capital runway that finally matches the company's ambition. In summary, the contrast between the historic 99% drop and the current $250 million financing deal creates a unique inflection point. The market is skeptical, and rightfully so given the past performance, but the strategic pivot toward precious metals and national recycling frameworks offers a path to relevance that didn't exist 2 years ago. We are watching a company attempt to rebuild itself in public, trading the volatility of a low float for the potential of a global standard. It is a high-wire act of financial engineering and technological scaling. Keep a close eye on the volume and the specific terms of the equity draws. In this sector, the structure of the deal is often more important than the news itself. Would you like me to analyze the recent institutional buy-in patterns for SMX or look into the specifics of their latest partnership in the gold sector?